Next is a conversation that most of you would have been waiting for, a man who gives sound advice and whose advice you would really want to turn to in such tumultuous times. Samit Vartak, founder and chief investment officer at Sage One Investment Advisors. He's joining us right now with his thoughts. Samit, thanks very much for taking out the time. Difficult times. And these difficult times require some bit of hand-holding, at least for the retail end of the investment chain. Right now, what have you made out of the complete fear that has gripped the market and the fact that in a period of 1 month, there have been times where you've gone from fear to FOMO, which is the markets have soared as well, and they've completely gone down to troughs too?
Yes. Good morning, Neeraj and Devina. Good to be here. It is, I think, one of the most hysterical period that I have seen in my life. I lived through the 1999, 2000 kind of .com, and then the crash, and then 2008 and 9 kind of crash. But this has been so sudden and so fast and furious that it's been almost impossible to react to this. So, I think what is adding to the fear this time is that not only is there a fear of economic slowdown or almost a collapse, but you see a lot of things around you, physically, health-wise. There are so many things you're worried in your real life. It does add to the fear psychosis, and that's something which hasn't happened at least in our lifetime. So I think that is where there is extreme volatility, because there is no way the uncertainty is so much that there's no way to evaluate what is going to be the impact, of this. But, I want to put a little perspective, on this. I think where this is different than what we have seen in the past. Even if you look at, say, the Great Depression that was in 1929 and, which lasted for 3 to 4 years. And to get the highs of 1929, it took until 1954 for the Dow Jones to recover the lost ground. So it was a humongous loss of wealth during that time. But I think what was different at that time was that the Fed took a lot of time to react. They did not help at all. And at the same time, the government increased the taxes. So the economy was almost left hanging, and it was almost the first time that it was happening, at such an extent. And the Federal Reserve, the central banks, were not equipped to do that. From that learning, I think they were able to reasonably well manage the 2008 kind of crisis of what not exactly to do. Something that they didn't do in 1929 and something that Japan didn't do in 1989 post that. So that is where Fed came in 2008-9. Again, in 2008, I think the big difference was that they wanted to set examples. There were a lot of political issues, whether to help Wall Street or not. They took a lot of time, from January to September to react, because the general public was against Wall Street. And hence, once Lehman Brothers collapsed in September, that's when everyone got together and then they acted. I think this time it's a little different. This time there is no opposition to helping any industry, at least in the Western world. So I think they have been very quick to respond to this, and they will not, I think, let go anyone down, because it's not anyone's fault. It's a natural disaster, and they have unlimited balance sheet, because dollar, it's compared to countries like India, where you are worried about your currency, the US doesn't worry about their currency. So they have unlimited balance sheet, and that is something which an investor has to take it into cognizance, that the reaction of the central government as well as the government will be significantly smoother and faster, and they will do whatever it takes to safeguard the economy as well as the financial system, because it's the financial sector that is what is the real worry in the world, in India as well as across the world. And that is something which I'm pretty sure about the Western world. I'm not so sure about India.
Actually, that's a very good point, because the response time, Samit, versus the global financial crisis has been extremely fast and extremely quick. And the overall improvement will mainly be a result of the success of the Fed and Treasury packages of rescue and stimulus. Keeping all of these factors in mind and the fact that we've already come off so sharply, Samit, how do you place valuations? Do you think that there is a possibility that you could see further deterioration in valuations? Because we are already, if you take a look at India valuations itself, we're now below the 15-year mean.
Yeah, so I think, see, there are two things that an investor needs to worry about today. One is valuation, and another one is what will happen in the longer run to the businesses. It's fairly reasonable to evaluate businesses and what will happen to the businesses, but valuation is we have seen in the recent past, right? I mean, something which like the leading NBFC, where everyone thought that it's untouchable, the valuations will stay at that 8-9 times price to book, suddenly comes down by 50-60%, and it just takes one event. There is a lot of comfort that a lot of investors get through recency bias, that the recent 7-8 years of high valuation, people extrapolate that to permanency. I think that's where the trap is. I mean, it's not just one example, but just look at the examples of Eicher, Page Industries, Havells, KRBL, Kajaria, VIP, I mean, Marico, Godrej Consumer, Maruti. There are so many of these highly valued companies which have not even just half, but some of them have come down by almost 70-80% in terms of valuation. So that's a risk that someone has to be aware of. When you look at the structure of BSE 500 today, the top 100 companies are still trading at a trailing multiple of 21 times, even after such a big fall. But as you go down the line, even if you just look at the bottom 100 companies in the BSE 500, they're all trading in single digits, so 6-7 times multiple. So you have a universe which, if you go away from the top, say 100 or 200 companies, trading at the valuations of the depth of the financial crisis in 2009, whereas many of these highly valued companies are still, I think, retaining that valuation, and it just takes one black swan event to just puncture these kind of valuations. So I think investors do need to be concerned and worried about, not extrapolating what's happened in a couple of companies like an HDFC Bank or an Asian Paints in the last 20 years is going to happen in many of these companies which have only seen maybe one cycle.
Well, that's an interesting point that you make, Samit, and I would want to dwell on that a bit. But just tell me then, are you advocating that if people are making fresh allocations, and are you making fresh allocations right now, or are you biding your time? And if you are indeed making fresh allocations in your portfolio, how are you managing the portfolio? Are you putting in companies from that bottom half of the NSE 500, which are quality names but trading at valuations around the global financial crisis?
Yes, Neeraj, I think that's a really good question. I think the big problem is, when someone asks you whether you are adding, most investors do not have the fresh capital. Most of them are fully invested, and that itself has taken a beating of 30-40%. And so, what do you do right now? So, of course, if you were lucky enough that you took a call of getting in cash before this crisis started, or at the start of this crisis, where we took some call and we raised some 20% cash. That money I'm definitely starting to deploy, because the valuation that you see, once the valuations hit the attractive point, the stocks will find reasons to bounce. And same thing happens the other way around. If the valuations are high, by some magic, the stock market tend to find some reason. It could be a black swan event or something else. It's easy to see that in hindsight. So it's very difficult to time once the valuations are attractive, and they're attractive because there is so much of uncertainty. And as I said, this is not comparable to any of the previous crises. This is a very short-term event where the actions of the government and the Federal Reserve are going to be very, very smooth. Now the question is, what does an investor who is fully invested do? I think this is an excellent time where, many of us have been holding at least few laggards where you know that these are not great companies, but you just couldn't get out because they have taken a hit. Now you have an opportunity where really good quality, excellent companies, whether it's in the small cap or mid cap or large caps, are down 50-60%. And this is a time to just get out, just forget about what prices you bought those businesses at. If you do not like the businesses, get out of those businesses and put that money into these great quality businesses. You will thank yourself for just redesigning your portfolio at this point in time. And you would think that generally you get paralyzed, that you don't want to even look at your portfolio, but just get active, get out of the poor quality businesses, whatever valuation they are at, do not have any kind of anchoring bias, and get into really good quality businesses which have corrected a lot.
Okay. Well, that's sound advice. And I think something similar we had spoken about the last time that we spoke on Alpha Moguls as well with Samit. But I think the timing wasn't conducive then. Maybe the timing is really conducive right now. So Samit, let's try and now talk about some of these businesses. One is businesses which are available at good valuations. But before that, where are, in your assessment, which are the businesses that will escape, and I'm using my terms very carefully, escape relatively untouched by the current crisis? Have you been able to try and identify some in your wisdom?
Sure. So see, I think it's this is really tricky, because in this case, we don't know how the situation will evolve and how the world will sort of adjust itself to the post-corona reality. So there are two ways I think you can look at it. So again, as I said, one thing is, which are the businesses which may come back to normal, but the valuations are permanently hit. So I believe that unsecured lending, where the valuations of 8-9 times, we have seen in the recent past, that's history. Even if those businesses come back to their previous strength, I don't think the valuations will come back to those 8-9 times. That's history. Where I feel so you need to differentiate between those businesses which will maybe come back, but valuations also will come back. So I think the spaces like specialty chemicals, contract manufacturing, entertainment, the cinemas, I think the strong airlines, those are the businesses which will definitely come back. The secondary impact of this is, how do we adjust as a world? Whether this experience of 1 month of working from home, whether it will maybe trigger companies to cut costs, and this becomes a little more permanent kind of a working situation. Not all, but they can reduce the fixed assets related to their businesses and allow more employees to work from home. Reduce the travel, rather than traveling, do video conferencing, because once you experience, you get a lot of comfort, and then you tend to continue those for a longer time. So in that situation, maybe we would need better connectivity, better networks. So something which is, the telecom ancillary space may see a huge jump, but you don't know whether these are. It's better to be late in identifying such trends than be too early, because you may take an impulsive call that, okay, a simple example like hand sanitizer. If you think that there is going to be a lot of demand for that, but as an investment, that may not turn out to be a great decision, because there is no barrier to entry in manufacturing hand sanitizer. You have to identify things which will pick up post this crisis ends, but also make sure that there will be only 1 or 2 companies who can do that. Not that anyone and everyone can get into those businesses, because that's where I think a lot of investors get into a trap, that if there is no barrier to entry, whatever the demand is, it can go up 10x or 20x. There is no economics left, and there is no returns left for an investor.
Got it. Samit, the other half is companies which may not necessarily get back to peak valuations, something that you started off with, but that the valuations have been decimated so much that just a normal mean reversion, not to peak, but to some normalcy, will bring gains as well, because the business is good. There is a valuation derating that has just been too substantial. Are there pockets like these? Would unsecured lenders be a part of that?
I think I would rather focus on the secured lenders in that space rather than unsecured lending because almost everyone is equally hit. Definitely that will come back because I think once this it's highly possible that we look back at this event as the highest hysteria that we have seen. It may not really turn out to be the risk that we are assuming today. And in that case, a lot of businesses will immediately go back to the normal. The life will go back to normal in a moment. Suddenly if there is a cure which is found or suddenly a vaccine is found. So I think that's where the FOMO kind of thing, where Davina started with, is coming. But it's important to realize what were extremely overvalued, even if they have come down by 50 or 60% in terms of valuations, those are still expensive, because historically such overvaluations only last for one cycle, and in the next cycle such overvaluation doesn't come back. I'm sure there will be other sectors where you will see such overvaluations, but I think it's better to focus on investments where you see the businesses coming back as well as the valuations are well below fair valuations and they just come back to the fair valuation, not the businesses where they're already come back from overvaluations to fair valuations and maybe the businesses will come back to normal. I think that's not where you will make extraordinary returns. This is an opportunity of a lifetime where you will be able to identify great businesses which are trading at half or 1/3 of the fair valuation. And it's better to, go there rather than bet on someone where it's already just at fair valuation.
Yeah. Right. Samit, the other question would remain is, in times of fear and adversity, that's the time, the brave get rewarded with disproportionate profits. And disproportionate profits is what I'm referring to from a mid-cap and the small-cap side of the market standpoint. They've completely given up the 2017 rally that brought the mid-caps and small-caps to these levels. At any point in time in this correction, did you feel that it was, maybe of value to look within the broader market space? Because sticking to quality is something everybody does. Everybody has spoken about it. Everybody has said that, while you are seeing this correction, there is going to be business continuity. The larger names are not going to run out of business. So therefore, this is just a small blip in the overall growth story for the larger names. But it seems like mid caps, small caps, where there are good value businesses, are sort of shunned away.
Right. I think that quality list is, by every event is shrinking, by the day. In a matter of 3 weeks, I'm pretty sure there are many businesses which seem quality are out of that quality basket now, and will probably never get back into the quality basket. So I think, this is an opportunity where you get extremely cheap valuation. See, this large cap, small cap, mid cap has been a differentiation mainly in this cycle. It's really never been that differentiation in the previous cycles. It was phenomenon of this cycle mainly because a lot of technical issues, SEBI triggered and all of that. But I think focus on the great businesses. There are so many of these mid cap and small cap companies which are in this 2,000 to 10,000 kind of a range, where they are extreme, almost monopolies. They are leaders. The difference between their business compared to the second player is much higher than, say, an Asian Paint and then the second player, or an HDFC Bank and then the second player. So those are the businesses where this crisis has actually triggered collapse of the competition even more than what had happened even before. And those companies, when the economy comes back, they have such a huge opportunity to gain market share that the growth that they can, accomplish would be very, very high. Even if the economy grows at 3% or 4%, their growth rate can easily go beyond 25%. And those are the businesses which are, where you can expect that they will double their earnings in the next 3 years, and at the same time their valuations, if they double their earnings in those 3 years, will go up 2 or 3x. And that is the opportunity I think one should look for. It is not that often that you get such opportunities to pick the leaders in certain industries, and there are so many of such companies available today.
Samit, one last question before we wind this up. Any advice to retail investors on how to, if they want to build a fresh portfolio, if they want to churn an existing portfolio, if they want to rebalance, what is the advice?
Yeah, so, again, as I said, I think every investor has laggards in his portfolio. I'm not saying laggards in terms of prices, laggards in terms of the quality of businesses. By holding them for last 2 years or 3 years, I think one definitely knows which are those, few companies. Just get out of those companies. Identify, 4 or 5 of great leaders in small or mid cap or wherever you think you are comfortable, and you realize that these are really strong businesses which have weathered through not only the 2017-18 kind of slowdown, but also this corona crisis, and get into those businesses. They may not have fallen as much as say 70-80% that many of the other businesses which have fallen, but there are many which have fallen by 50-60% and are trading at well below the fair value. Those companies, there are many such companies which will, look at companies which will double their earnings in the next 3 years. If that happens, most of those companies will at least double their valuation. And that's the opportunity you have to make up 4 to 6x kind of money in the next 3 years. And it may seem really bleak at this point in time, but these things can turn in a dime. If you haven't been lucky enough to get into cash, forget about it. What happened in the past is past. Don't be guilty about it. Just see what is the best you can do looking forward. And once you do that, things can change in a very fast time. You can recover whatever money you lost in the next, very foreseeable future. Do not get anchored to the same stocks and just, based on your emotions, try to make up the money in the same stocks. It's better to move on to the stronger stocks and let go of your, weekly.